Hello and welcome to Property Matters, a weekly look at all matters property designed to be of interest to anyone who has an interest in the property market. Property Matters is supported by Fairview International Property Consultancy and auctionproperty.co.uk. Each week we talk through the big stories of the week in property and we chat from time to time to various property professionals to get their view on the world that we love, which is property. So we'd love you to get in touch and get involved with the conversation by adding your thoughts in the comment section below the video wherever you're watching us today. And of course, don't forget to like and subscribe and all that good stuff so that you can find out when we go live on our channels. And don't forget the email address, propertymatterstv@gmail.com, should you wish to suggest stories or any items for us to cover in future shows. Welcome as always, Joe Joshi. Today we have a special guest with us, Joe.
Yes, hello and welcome everybody to our Property Matters program. We have some interesting subjects to cover over the next few weeks. And one that's been pretty close to my heart is a subject we're going to cover today. And so we have Agam Jain, the CEO of Vector Capital, here with us today. And so once Paul has done his graphs and things for me today, then I'll go into talking about why we have Agam with us, and why I think it's quite a relevant subject and program to all those investors that I continue to speak to each week.
Yes, welcome Agam. Welcome along to the show. Not your first time.
Good morning, Paul. Good morning, Joe. And good morning to the audience.
Yes, not your first time with us, so you are used to coming on the show with us. So it's welcome back, of course, and you're here with Vector Capital to talk about co-funding today. So we'll come on to that, as Joe says, very shortly indeed. Let's just have a quick chat about the month of February, because we've just turned into another month. So every month we get the Zoopla property data. Basically, the situation this month is that the average house price growth has slowed from 8.4 to 8.1% in February, taking the average value of a house to £245,200. Wales still is the big place to invest right now. London is at the slowest, so if you go and invest in Wales, you're looking at 11.8% growth, whereas in London it's as low as 3.2%. New supply of homes to the market continues to grow, but it's very slow. It's just up 5% on the 5-year average, but it's a busy start to the year. And Agam, I was going to come to you first, if I may, and just ask you, do you see regional hotspots when you're looking at investments? Do you look at it from a regional perspective? Can you see there are areas that are exciting to be in at the moment and areas that are not so good?
Okay, so like you mentioned, Wales is showing a lot of growth at the moment in house prices. And you might note that Aberdeen has sort of gone down in about 13%. So yes, there's quite a stark sort of variation regionally. Having said that, we sort of focus mainly on England and Wales. And I'm surprised myself, that the growth in house prices are still carrying on. We'd have thought we'd have plateaued out by now, but it's still carrying on.
And I guess, Joe, there's a lot of companies have now sort of said to their staff, well, you can hybrid work, you can work entirely from home. So companies have had the time now to think about where this is going to go for them, how they're going to work going forward. And now companies are able to say, yes, you can literally live anywhere and work for us online. And that's why people are starting to it seems like the beginning of this year is the start of the year. They thought, right, this is the year we're going to get ourselves settled.
Yeah, I think, Paul, it's interesting. First and foremost, it's interesting that house prices have continued, and it's only backing up everything that I seem to say week in, week out about investment in property is probably the safest investment anybody can make. It makes people feel that they can touch, feel, and see what they are buying. And that is sort of the basis of it. Now, in terms of why we've got here and how we've got here, it's really about the last couple of years and that direction of what the pandemic has done and the way people work, live, and want to sort of grow their families. The key thing always here is about choice, and the choice has widened. When you look at people looking to buy property, originally they would have probably sort of stuck to a given area. And those areas are determined by perhaps their own personal lifestyle, family, other commitment, child commitment, schooling, etc., etc. All of the above are the reasons why people tend to sort of stick into an area. But this role of job changes and the way people work has actually broadened that. In fact, it's allowed people to move further afield, especially also considering education, because there are other hotspots and other areas in the country where education is good, schooling is good, and people feel that they could actually now maybe move further out, get a better value for money, and have a change of lifestyle. Of course, the key thing in moving out, as I've said to you on our program before, is that as long as the internet is very, very sound and good, because the internet is now a driver in house prices as well as many other things. And if there is a good internet supply into that area, then that is also determined. In fact, I think we may have covered that subject some time back. It could actually mean a difference of £10,000 in a value of a property, whether it's good internet or bad internet. And it's quite a key thing that people now consider. So moving around the country has made it a little bit more flexible since the pandemic. And of course, how employers do take a view as to where they want to have people working from. And that part will be driven by the quality of housing and the quality of internet.
There's two other factors that Zoopla identify as being one of the reasons, or the main reasons, why there's so much activity in the market. There are, if you look at it from a seller's perspective right now, they're looking to lock in the gains. So they've had the fantastic growth over 2021, thanks to the stamp duty holiday. And now they're thinking, I need to lock those gains in because the headwinds are coming. Things are looking, from April 1st, prices are rising. We've got Ukraine and all the other situations in the world that are affecting our economy. And therefore they're thinking, right, I need to get at the top. I need to get out of the top here because I think things are going to slow, prices are going to fall. But you've also got the buyers on the other side saying, do you know what, I'm a bit worried about interest rates. I think they're going to rise. I need to lock in my 5-year deal and get the lowest possible price. So you've got sellers keen to sell to get the maximum amount of gain. And you've also got the purchaser thinking, I need to get my mortgage sorted quickly. So those two together are surely fueling the market as well.
Undoubtedly. I mean, when you've got the rates still at 0.75% as the base, is still the cheapest money you can actually get. So there are good lock-in interest rates for 3 to 5 year interest rates as fixed. And of course, that means that people can know exactly what their outgoings are going to be, especially over the next 3 to 5 years. Given the fact that we endorsed the 31st of March as a meter reading day, as you know, look what happened there. I mean, apart from the sites crashing, the cost of electricity and gas and so forth, all the utilities is gone high. And part of the move, Paul, of people moving outwards is equally determined by these costs, because if they can get a better value for money home a little bit further out, they can probably sustain the pain that is now going to be endured upon them on the utilities on an annual increase. So that spread out over on a monthly basis could actually mean that they could reduce their borrowing but fix it at a lower rate by moving further out. So all of these things are actually determining how people are thinking about moving and where they're moving to. And of course, that is what continues to keep the strength and the growth in the housing market and the house prices that are continuing to grow. The supply and demand factor is always a driver. The demand is very, very good, and the supply, of course, is somewhat limited at the moment.
And Agam, as somebody who's a professional property investor and working with property finance, are you still positive about the year ahead in terms of investment in property?
Yeah, I think one of the factors to take into account is that inflation is now going to become a topic that we haven't sort of considered over the last 20 years. With all the prices of energy going up and the impact on even building materials, etc., everything is going to add to a high inflation rate this year. Having said that, if we look at the 5-year growth in property prices, even if there is a slight adjustment over the next couple of years, over the next 5 years, it's probably the only sort of investment that's going to keep pace and maybe outstrip inflation. So yes, I think you've always got to factor in the odd dip here and there, but over a 5-year period, yes, I think it's still a positive upward trend.
Yes, we stated at the beginning of this piece that 21.5% is the growth over 5 years, which is still strong and impressive. And Zoopla have got the figures here in front of us on the screen. So the purple lines show the annual percentage change in price against where the pink dot is the 5-year price. So where the dot is below the purple line, you'll see that area has actually surged ahead of the 5-year price, but whereas the dot is above, it's where they haven't. So Wales, the 5-year price is still strong, but it's not growing as fast as the 5-year price. So that's good value. The southwest, the southeast, the eastern region, the northeast, and similarly London. In general, the price this year, this last 12 months, is stronger than the 5-year average. So it just goes to show those regional differences. You've got the East Midlands, the Northwest, Northern Ireland, Yorkshire and Humberside, Scotland, all performing under their 5-year best, and that's where the investment seems to be most keenest. So it's quite interesting to look at that. And lastly, on this, earnings to house price ratio. So the house price against the earnings ratio. So look at London falling at the end here in 2021. So getting better value, but still way ahead, of course, of the south. The Midlands in the middle. Wales is the yellow line, and then the north and Scotland at the bottom there. So you can see there's still quite a spread between affordability in London and Scotland. So we're not really levelling up, Joe, are we?
I've never ever thought we were going to level up. It's just a job for the new title, really, as you know, for leveling up. The demand in the brighter cities, in the faster cities like London, will never ever sustain, because we've seen historically in the 40 odd years that it's just not something that people are going to go. Yes, there are driving factors or what happen around the world that can affect it, and things like the pandemic and now the war and all that kind of stuff do affect it, but not for an unlimited amount of time. It's a little bit of a pain, but eventually it comes back out again, and people are still driven back to places like London time and time again. And as you can see, there is a growth, but maybe a slow and steady growth, but there's always a growth. It's never been one that's gone off the Richter scale. So I'm not surprised at that. And of course, the difference will continue. Sadly, as much as we are desperately trying to do the leveling up and providing all the facilities, there is such a magnet to the bright lights of London, not only just from corporates and people, but the youth. The youth are driven by the fact that they want to be where it's happening, and London is still where it happens.
The average sale takes 29 days at the moment, and they reckon there'll be 1.2 million transactions in 2022. So that's what we look at every month. When the month turns, we get all the data from Zoopla, so we always have a look at it. And again, seems that the property market is proving to be incredibly resilient despite all the headwinds in the world that we're more than aware of. So, Joe, we mentioned that we're delighted to have a guest with us, with Agam from Vector Capital today. And you've been a long time exponent on this show about alternative investment opportunities, because there comes a time in your life where you might be fortunate enough to come into some money from various things happening, family and property and so forth. And the natural thing that people seem to do is to go and buy a property, rent it out, and get themselves an income, which you can't criticise. But at the end of the day, do you really want all the hassle of having to look after tenants? Do you have to have all the hassle of complying with the law, which is getting ever more complex? And you've often said that there should be an alternative, and I think that's why you wanted Agam to come and talk to us today about co-funding.
Yes, Paul, thank you very much for that, and welcome, Agam. My beef has been for many years that there isn't an alternative. There comes a time in a lot of people, and I see this literally at the front line, where people have got investment money, and they're at a certain time in life. So, without any discrimination or prejudice, I mean, you get to a certain point, 55, 60 years old, you want to start to think about enjoying your life. You've done your turn, and then all of a sudden you think, well, I'm not getting enough income from a pension. I'm not getting income from my savings because the ISA is only giving me, XYZ amount of interest on return. I've got a couple of £100,000, maybe 100,000, even maybe £50,000. It really doesn't matter about the amount. The main thing is that you're not getting the best form of return for your money. And so over my time, I came across Agam and Vector Capital, and I came across a concept that I thought I'd really love to bring to our show and bring to my clients and bring to my and our viewers here. So that's why I invited Agam to come and join us and share with us the benefits. So I'm going to outline what I see, and then hopefully Agam can support that and help us with what we think it is. I think that there comes a time when people say, well, actually, I'm going to go and buy a house or a flat for a couple of £100,000 for argument's sake, and then they're going to get a rent return on that, maybe around between £800 and £1,000 a month. But what they have to bear in mind is there is also costs after that. For example, there are going to be buildings insurances, other insurances, and then of course some sort of agency fees that you're going to be paying out on, and so forth. I think probably for me personally, the reason I bring this to our viewers is that there is a huge amount of work that is involved in earning perhaps a little when you could actually probably enjoy your life and have a safe investment. Again, what attracted me about this is that investment is in property. So we are Property Matters. I love property. It's what I sing and dance about every day. And as far as I'm concerned, this is an investment in property, except you don't actually have to go and buy your own couple of 2-bedroom, 1-bedroom flat. You can actually co-invest with Vector Capital, and they will give you a return which is much higher. And it's always about individual circumstances. So I'm not going to state what and how much, and that is something that you would have to approach Vector Capital and Agam, and they will put you a proposal that they feel that they could offer. But the things that I have seen so far, and for the clients that I have recommended so far, they have been quite surprised at what they are getting, and they are getting that sitting at home and not having to think about the leaky tap. That's the way I look at it. So Agam, welcome to our Property Matters show. I know you've been here before. I'm a supporter of your co-funding, and I'd like you to share how our viewers and potential clients that we may refer to you who would benefit from that.
Thank you, Joe. So, Paul, do you want to move the slides then, I suppose?
Yeah, tell us a little bit about Vector Capital first, if you would. That'd be great.
Okay, so a little bit of background. We did our first loan in 1999, so I think that makes this year 23. So there's a bit of experience there. And what we do is we provide bridging and property development finance throughout England and Wales. We concentrate on the sub £3 million size of the market. So we're not doing huge projects and risking a lot of capital on one big project, but we've got a very large spread, both geographically, and average sort of loan size that we do is about £600,000, with quite a few that are around 1.5, 2 million. So there's a good geographic and a size spread. The type of people that will come to us are small developers that will find maybe a dilapidated house or an old office building, and then they'll want to convert it to flats, and then either rent them out or sell on, or then transfer it to a buy-to-let mortgage. So that's our market. The main thing to know about the Vector Capital as well is that we're a very professional company. We're listed on the London Stock Exchange, and we've got an excellent track record, and everything that we do is public information. You can go to our website, or you can go to the London Stock Exchange website, download all our accounts and growth figures from the internet.
And how is Vector Capital regulated then in any way, or is there any regulation?
Okay, so regulation in the UK applies to people that buy houses that they're going to live in. Okay, so that is a sector that companies like us don't get involved in. You would go to somebody like Halifax or NatWest or Barclays for a high street mortgage on your own house. The type of people that would come to us are business people that would be buying the property for refurbishment, development, to let out, etc. And that sector is unregulated. Having said that, being a listed company, we are audited 9 times in a year. We've got bank lines, so they audit us every quarter, and then we have to have the big audit, and then we have to meet various requirements for the stock exchange. So we are sort of very heavily vetted and audited, but lending to the sector where it's for development is not regulated.
Okay, so let's just talk a bit about the opportunity. Let's to explain what co-funding is, if you would, Agam.
Okay, so we market to hundreds of brokers up and down the country, and we're fed with various inquiries on a daily basis of people wanting to borrow money to buy property so that they can develop it, and we are able to charge a higher rate of interest than you can on a home mortgage. Now, we primarily fund this from our own capital and bank credit lines that we've got. Our capital comes from the fact that because we're listed, we've got a large base of shareholders. Now, say we get inquiries where we've funded it ourselves, but we can then offer that to people who want to co-invest. So we can publish a list on our website via invitation. So we give you a login, so you can go into our website. You can see all the properties that are up there that we financed and that you may want to then come in and co-invest. So I think on the next slide, I'll be giving you an example. So shall we move to that one now, Paul?
Yeah, I was just going to ask you first, because you said you lend to people who are property developers, smaller property developers who are obviously professionals in what they do. But this is a chance for people who don't necessarily have a great deal of property knowledge to invest in something that you have already vetted and had a look at yourself and think is a good opportunity. And as long as it's managed well, they can come in with you and assist, and that's what co-funding is.
Yes, but it can be easier than that, because the co-funder can also choose from the list of projects that we've got on our website which ones suit him. So, for example, I would say 80% of the loans that we issue are for people that are buying a property and just doing internal refurbishment. Yeah, there would only be about 5 or 6% that would be ground up developments, that where somebody's actually buying land and digging it up and then building from the ground upwards. Okay, so depending on the comfort level, the co-funder can choose, okay, no, I'd rather just maybe fund a buy-to-let property where there's no development going on, but then the rate that we are able to charge and then consequently give on to the co-funder will be lower, where then the next stage would be internal refurbishment, where the rate that we would charge would be slightly higher, and so more is available for the co-funder. And if you got an appetite, then you can actually come in on a full development project where somebody's building a block of flats, or and then the rates that we charge would be higher, and then the return for the co-funder would be higher. Now, having said all that, we do a lot of due diligence before we issue any loan, because obviously it's in our interest, because we're funding it initially, to make sure that it's completely safe as can be. And to give you an idea of our track record, over the 22 years that I mentioned from 1999, we've never had to actually ever write off a capital loan. We have had to write off costs in recovery and maybe some accrued interest, but we've always recovered our capital. And all this information is public and is available on our accounts.
Okay, let's have a look at that example you mentioned there. So you've got a property here valued at 1.5 million. Tell us about this.
Okay, so say the property is valued at 1.5 million. And we've decided that we're happy to lend 1 million against that project, okay, or the property. Now, we'll have done that with our own money, but then we'll put it up on our website, and people that want to then come in on that can say, all right, well, look, I'm happy to come in at, say, 400,000, for example, on that property. I'm just doing larger rounded figures just so it's easier to understand. The projects can be much smaller as well. So what we would say to you is, okay, we've got our first legal charge on that site. Okay, so if anything ever went wrong, we can just step in, sell the property, and recover the money. Now, as a 40% co-funder, what we would say is that we'll give you a 40% share of the legal charge that we've got, so that if we end up having to repossess, whatever proceeds we will get, we will share with you in the 60-40 ratio. Does that make sense?
Yeah, absolutely. Okay, so let's just look at the deal structure. So about protecting the investment and the trust deed and that kind of thing. So the legalese, how does that work? How is the investor protected?
Okay, so we've gone to a great length to make sure that the legal protection for the co-funder is as good as it can be and is solid. We use the firm called Memory Crystal, which is a large city firm that specializes in this, to draw up sort of documents in plain, simple English. And what it basically means is that we've done the deal. We've got a first legal charge on the site. Okay, we will put that legal charge into a trust. And then the beneficiaries of that trust will be Vector and the co-funder. Okay, now the co-funder can be just one party, or there can be 2 or 3 co-investors in the deal. So somebody might come in at 200, somebody might come in at 100, somebody else might come in at another 100, and then Vector's done 600 on it. So that means then there's 5 parties in that trust, all being beneficiaries in that proportion, 60%, 20%, 10%, and 10%. Okay, so that way the legal charge is there. So you've actually got bricks and mortar, a share in that bricks and mortar security.
One question that's just come to me as we're talking, Agam, does the co-funder have to come in at the start of the project, or can they join partway through? How does that work? Especially if there are others involved.
It's probably more convenient for us that we do the deal initially ourselves. Okay, then we put it up on the website and say, look, these are the list of deals that are available. Because say a borrower comes to us, we don't want to be hanging around whilst the co-funder is oohing and eyeing and thinking about it. We need to do our business and get the deal done. So we'd prefer to just do the deal, put it up on the website, so you can then come in at any stage. So say usually we'll give a loan for 12 months. So ideally what you should do is when there's still 11 months to go, maybe come in then so you can benefit for 11 months at least. Okay, now obviously if you're going to come in just 2 months before expiry, then you're only going to get 2 months benefit. But so yes, you can come in after we've done the transaction.
Okay, so the transaction process, what happens here?
Okay, so initially what we'll do is you'll pick a project that you like from our website. What we'll do then is we'll give you a term sheet, which will say, all right, for the 400,000 you're going to invest, this is what interest we're going to pay you. Okay, then we will also give you a copy of the RICS valuation. RICS, I'm sure all the audience understands, is the Royal Institute of Chartered Surveyors. So we always get a valuation done by them, where we have various valuations. So one of the valuations we have is the market value, then 180-day market value. That means that if we possess the property and gave ourselves 6 months to sell it and complete. And then we also have a 90-day valuation on there, which is that we want to put it in an auction and get rid of it quickly. Okay, so the co-funder can actually have all that data. The valuation will also give them all the property details, the pros and cons, photographs, street scenes, everything. That is 60-70-page document. We'll also then give you a very simple funding agreement written in plain English, so that you don't need a lawyer unless you want one to actually understand what it says. once you've made your investment, we'll also give you an acknowledgement and a copy of the trust deed. Now that trust deed is going to be lodged with a firm of solicitors. So you don't actually have to incur any legal fees if you don't want to. But if you're extra cautious, you can also employ your own solicitor, but then you'll have to pay his fees and he can check over the documentation. But we use a large city firm called Gunner Cook, and they hold all the trust documentation, and they will write to you and acknowledge that they're holding it on behalf of the trust of which you, the co-founder, is a beneficiary.
Mm. And essentially anything that happens with that loan to the borrower, VEC to make all the decisions. So if they need further finance or if they want to pay back early, that kind of thing, you handle that on behalf of the co-funder. They don't get involved in that decision making.
No. So the co-funder is a silent investor. So our team at Vector will make all the decisions. And it often happens that somebody asks for a 12-month loan, and then at the 11th month, they request, can we have another 6 months? Can we have another 12 months? Now, it's usually in our interests to extend that loan because then both parties can earn more out of it. So we usually agree to it. And during the lifetime of a loan, sometimes people will pay a little bit of capital back early if the progress is going faster than they expected. Or sometimes they'll ask for an additional advance. And what we will do as an underwriting task is to see if there's enough equity left to give them an additional advance, and if there is, we'll give them an additional advance. So, and a lot of times, well, I wouldn't say a lot of times, but several times, people may just feel that we don't need the money anymore, and they will want to redeem the loan. So, although we give them 12 months, I like to think of us as the Marks and Spencers of the lending business, where people aren't sort of tied down into knots if they want to redeem early. So we're not going to say to them, no, this was 12 months. You have to. So if after 8 months they want to redeem, we'll take it without any penalties. But the co-funder will also then get paid back simultaneously. So he might have anticipated 12 months, but there's a risk that he might get paid back earlier.
My old grandma used to say to me, there's many a spill between cup and lip. So sometimes things don't always go to plan, Agam. So what happens when things go wrong? How do you manage default?
Okay, so I'm in total agreement with you. For every 100 loans we do, there's only probably about 10 or 20 that are absolutely smooth. Okay, so it's a very high percentage where there's a lot of variation during the term. And it's the usual thing that I haven't got the cash flow to make my monthly payment this month. Okay, so we give them a bit of grace for maybe 2 or 3 months. So that's the most common thing. Then the other thing is that sadly, maybe 10% of them do get into difficulties. We try to be helpful and sort of show forbearance, but at the end of the day, we've got to protect the interests of the co-founder as well as ourselves. And so we'll usually say to them, look, try and refinance or get yourself sorted in the next month. If you can't, then what we do is then we appoint a receiver and we take over the property. And at that point, we'll make a commercial judgment. And this is where I've had lots of interaction with Joe. We'll either say, Joe, we don't want to be hanging around for 6 months. Can you put it into an auction? Okay. Or where we feel, look, it's better to spend the 6 months marketing it properly because we'll be able to achieve a much higher price. Okay. So then, so they're the decisions we make. But to put it in context, there's only about 3% of our loans that ever end up having to go to that stage. Okay. And 0% where we actually lose the capital. Okay. What we will often lose is the interest that's accruing since we put it into receivership, and then the costs of the auction company or the estate agent and the receiver. So sometimes we're not able to recover that. Okay. But the capital you'll always get back.
Mm. So obviously it's those additional costs of the receiver and the auction, etc. Those are the things that come out of what would have been the profit.
Yeah, no, what we would do is we wouldn't get the co-founder involved on any of the recovery process. We would deal with all that ourselves. Mm. And we would pay the bills for the receiver and for the auction company ourselves. And then we would share the statement, give a detailed statement of what we recovered and what costs there were, and whatever is left over, which is usually more than we're owed, we would then split in the ratio 60-40 or whatever the percentage ratios was between the beneficiaries. And if there is a shortfall, then that's the co-funder would share that in his percentage as well. Yeah. So if there's a £1,000 shortfall, and so we'll be hit for 600, and then the co-funder for the 400. Yeah.
And I suppose the comfort for the co-funder is that you will have, of course, done your due diligence. You'll have done a risk assessment because you've got your own skin in the game, haven't you, as Vector?
Well, we're assuming that some co-funders will come in, but if they don't, it's all our skin in the game, isn't it? Yeah.
Yeah, absolutely.
And also, we don't probably want to be putting up deals where we think there's the slightest little chance that there might be something like that, because we want these co-funders, as soon as they get redeemed on one deal, to have the appetite to come back again and then tell their friends about it as well. Yeah. So safety for us is primary. If there were sort of like slightly higher risk deals where there's a lot of development, ground up development or something, we'd probably not invite co-funders on that anyway.
And if the worst thing happens, the trust structure cordons off the asset as well. Yes,
yeah. That is cordoned off. That's what the trust structure does. It cordons off the asset so that Vector doesn't have any further claim outside its percentage as a beneficiary.
Is this type of scheme quite common in the UK, Agam, or are you the only guys doing this?
No, there's quite a few people doing it. In fact, there's a lot of automated platforms of companies that just base their whole business on this basis. Okay, and what they do, there's a lot of peer-to-peer, for example. Although what our proposition isn't really peer-to-peer, because we're already doing the deal and we're asking somebody to come in as a co-funder. Whereas peer-to-peer is where somebody requires a loan for 100,000, and then you get 200 people coming in, with £500 each or something, and then when they built up enough, then the deal is done. But in the type of market we're in, we couldn't give that uncertainty to our borrowers. The borrowers that come to us, once their due diligence checks out, they're expecting to put in funds so that they can complete their transaction. So we wouldn't really want to do things like that. But the answer is yes to your question. There's a lot of people doing peer-to-peer, which is similar to co-funding, and a few people doing co-funding as well. But I think we're the only publicly listed company that's doing co-funding. So that, from the co-funder's point of view, is a big plus in terms of security. You're not dealing with a private company and relying on what they've told you. You can actually check out information out, from public websites.
So I'm committing my funds to you for a period of time, as you said, for example, say 12 months to keep the figures simple. But what happens if I suddenly need to get my money back in 10 months' time?
Okay, this is for big boys, but supposing you've given us 50,000, and then 3 months later, you say, look, I really desperately need that money. For us, because as a percentage of our turnover, that will be very insignificant. So we are in a position to say, all right, look, just for goodwill, we'll refund your 50,000. But what we'll probably do is say, well, look, you'll forfeit any interest that you would have had on it.
Yeah, so you get your capital back. But as you say, that's not really what you're entering into it for. And if you're going to think you're going to need that money, you probably shouldn't be doing this in the first place.
Yes, and you'll know at the time what the term of the loan that we've issued, and you may also want to be ready that if we extend it, that are you up for extending it? If you're not, we'll still extend it, and then maybe at the end of that term, we'll say to you, look, you can have your money back if you want. Okay, but we're thinking that the type of people that will want to come in on this might have bought a flat, for example, that they would have had for the next 20 years. Yeah, so if they come in on us for a loan that was originally 12 months and then it gets extended for another 12 months, well, hey ho, that's benefit for you as well. It can be for 24 months. If it gets redeemed early, doesn't matter. Take the money back, and then you can put it into another site from our list.
And it's important that people should do their due diligence, not just on the investment, of course, but as you mentioned earlier on in Vector Capital, and you've mentioned already that all of your financial results are there in the public domain, and that you're vetted and audited 9 times a year. So there on the screen is the details that people need to have if they're interested. But also, let me put you on the spot finally, Agam, and ask you to give us some contact details of how we can get in touch with you.
Well, you can contact Joe, or you can contact myself. Our contact details are very easy. mail@vectorcapital.co.uk. And you'll see the enthusiasm that we come back to you with straight away.
And we've got a phone number on the screen there for Agam as well. Agam, thank you very much indeed. Fascinating conversation there. And Joe, quite an interesting opportunity for investment.
Yeah, I mean, it's probably the longest you see me sitting there silent, Paul. I know I've always got plenty to say, but I'm grateful and thank Agam for being absolutely clear and concise with the questions that you raised. And they're all questions that, to be honest with you, any of our viewers, listeners, and introductions would actually want to check on. I didn't want to bring Agam onto this program just because it was good for our health. I really wanted to bring him on because I think it's a really great opportunity for a certain level of person that has a certain amount of capital and doesn't particularly want to do buy to let. I think it's a fantastic alternative, and it gives a great comfort. The key in that is that Agam and Vector Capital are doing it anyway. They are going to lend. They do their due diligence. They are in it, as you say. They have full skin in the game. But what they are offering is a co-funding, an opportunity for someone to feel that they're safe because they've done the due diligence. They have the larger part of the investment or the loan that they've done, and it gives them. For me personally, what I like to endorse in that is that it is bricks and mortar. Ladies and gentlemen, it is exactly what you do every single day of your life. You buy and sell, and you invest in property because property is the most safest and securest form of investment that you are likely to ever do. We know that. 40 odd years later, I can tell you that that's what kept me here. It's as safe as houses, as they say. It's the safest investment you're going to make. And what Vector Capital does is actually invest in exactly that and offer you a share. So if there's anyone that's out there that feels that they want to have a discussion on that subject further, please feel free to give me a call. You have all Agam's details, which is published there, and share this story with as many as you like. But I just think it was really key to bring this subject to the table. And thank you, Agam, for joining us today and sharing that. And hopefully together we will all benefit.
Indeed.
My pleasure.
One final little chat for us today before we depart. I had to share this with you. One particular company has called the Home Views New Build Buyer's Guide. They've come out with the top regrets that buyers have had. They've interviewed 7,000 buyers over the last 3 years and asked for their biggest regrets about buying a property. 36% said that they wished they'd researched details of the lease, the management company looking after the lease, for example, or the building developer in the first place. A fifth said that they wished they'd looked at the quality of the garden, poor drainage and rubble, making it hard to enjoy their garden. 18% of homeowners said they wished they'd had a snagging survey, and 15% wished they'd visited the property at different times of the day. Joe, give us some of the top tips that you can give anyone looking at buying property at the moment that they might want to take into account when looking at buying a property.
Well, Paul, I mean, I smiled when I saw this particular point because throughout the years that I've been selling properties, I've often said to buyers that there are many things that they should do. But the problem is that the enthusiasm at the time of buying a property, there are a couple of things that they want to know and do, and that's all they tend to do. And it is later on that they tend to regret. So going back and winding the tape back, the most important thing is, I love it, I want it, how much is it going to cost me, and where do I sign? And that's probably about the context of what people get. That's the enthusiasm, the emotion that people get involved in when buying a property, especially if it's buying a home as opposed to a house. Those that buy a home buy it with emotion, and sometimes are excited about what they see. You know, all that glitters is not gold is a terminology that comes to my mind. And here is a scenario when you're presenting your home, and as you probably know, I've constantly been an advocate of presentation from the outside, how important it looks, and why buyers make certain decisions. These are all of the reasons why new homes, when they're presented with a show facility, they're presented with a fitted out show house, a nicely manicured, groomed garden at the back, and so forth. And you walk in and you just buy the whole romance of I want to live here. This is me. I can see my clothes in that wardrobe. I can see me lying on that bed, and I like the side table, and all that kind of stuff is what people tend to do. But of course, it is important to see properties at different times of the day. It is important to see properties when they start building them and to when they finish them, so that you have a journey there. You may not always have the time to do that, but those are good things that you need to do. The other thing that matters in these things is how the house faces. It'd be surprising how many people buy a property and not realize which way the garden faces and why it becomes an issue at a later stage. And of course, anything that's north facing, that's not deterring every not northern face property, is going to be cold, because the sun rises in the east, sets in the west, and there's no sun in the north. But if you've got a longer and bigger garden, you might get some of that at the end of it. But nowadays in modern houses, the gardens are no more than a postage size stamp. So you got to make sure that things like that matter, especially if you are a keen gardener and you want to look for garden and you're outside and you enjoy the outside space. If you don't, like my favorite people, the millennials, they don't mind if it's northern facing, because they're probably never going to sit out there unless it's the day of a barbecue. And then they'll have that delivered by Deliveroo or something, so that's that's my little thing for them. But other than that, I think it's important to go at different times of the day to see how that property does sit there. It is important to check, and that's where auction side of my business comes really handy, because most of the things that we provide up front. So often the case with buying a conventional private treaty property is you go and see the property, you like it, you start the process, your lawyers start to do all the due diligence for you, and in that comes service charges, other costs, and so forth. And you're a bit too far down the line to turn around and say, well, actually, I don't want to pay an extra £100 a month or whatever, because you bought it emotionally. And that's always going to be the difference between a home and a house. So, and when you're buying a home, you're buying it emotionally, you love it. You're going to just say, okay, it's another £100, I'll pay it, I'll do it. And maybe at a later stage, that becomes something that comes and bites you on the bottom and says, okay, you paid too much. And then the next guy says, well, actually, that's too much money. I don't want to pay that in a service charge, especially if it's in a flat or a block, and the management company charges extortionate amount. As you know, the lease process is in the current state of being changed, and all those things will get changed going forward. But yes, all previous stuff, there is importance to check out what you need to check out, especially with management companies, because there are extra charges, and those charges start to. The reason why those charges come in, Paul, to be honest with you, most people actually just sort of stick it in the bin and think, well, yeah, I've got that statement, I don't need to. It's paid by direct debit, I'm not going to need it again, so they put it in the bin. When you come to sell, people want evidence of those payments. So what happens is you write back to the management company, and guess what? The management company says, yes, we'll be happy to supply that. It's now going to cost you another £150 plus VAT for us to do an admin cost to provide you with the copies of all the things that you probably should have said. So do take heed of that so-called rubbish post that comes in, and you think, oh God, another bill, I'm going to shove it in the bin. Actually, it could cost you further bill, which you probably don't think is necessary to have. So important to make sure that you keep all of the bills, all the invoices, all the statements from your management company, because you're going to be asked for that when you come to sell it. And if you can't supply it, you're going to have to ask the management company, who, funny enough, are going to charge you again for the same information. So that would be a good tip for you, to make sure that you keep all of those things. I always say that good tip is always to make sure the outside looks presentable. And when you're doing the rubble comes into new houses, what happens is, even disposing of rubble is a cost. So some developers may just shove it in the gardens below, and then sort of make it all green at the top. And it's not until you decide that you want to actually maybe plant your bulbs and your potatoes and so forth that all of a sudden you're digging out rubble, because grass will grow pretty much anywhere, or rubbish will grow anywhere, but potatoes may not. So it is important to understand what kind of things are put in the ground, but they are done because it's cheaper for them to shove them in the ground than it is to put a truckload going somewhere else, which is going to go to some sort of landfill, and that's going to cost them. So it's all about cost in every possible way, that I think there. But it's interesting that it is after the effect. So the home and the house, I'll just define that. The home is something we are going to buy emotionally because we're going to live in there, going to love it, and we can see it. A house is something that you're going to buy perhaps to rent out, and you don't really have so much care in it. And perhaps that's the one you do more due diligence on than the home, because the home is where the heart is. The home is what you're doing because that's what you want to live in. So I think it's a good thing to do as much due diligence as possible. But when it's done, it's too late. So I think, hopefully that's helpful to some of the people.
And presumably, Agam, when you're doing your due diligence on investment opportunities, you're visiting sites and having a good look and making sure you've got all the I's dotted and the T's crossed.
What we do is we use this RIC surveyors, and they give us a 60 to 80 page report, and they list on it all the pros and cons of the property. So we're not even trying to pretend to do it ourselves. We're getting a professional to actually, and they actually give us a summary page where they write down, what are the sort of downsides of the property. Parking is probably one of the ones that always occurs to me, although not from our point of view. But if I was a house buyer, for example, maybe they're allocating you one space, but then think about it in the future. If any of your children or your relatives want to visit you, they can't park. If you want to have your housewarming, none of your guests can park. Okay, and I'm finding that in the last 20 years, with all these flats being built with such limited parking, I'm just thinking you can't even think about having a housewarming for your flat, can you? Right? Nobody's going to be able to visit you. That's something that sort of popped up in my mind.
Yeah, absolutely. Well, gentlemen, thank you so much. Thank you, Agam, for being a guest on the show, and thank you for explaining co-funding to us so succinctly. Joe, thanks for your wisdom as always, but we're out of time. We've spent best part of 50 minutes talking this morning, which has been an absolute pleasure as always, and where does the time go? So thank you so much. Thank you to you for watching Property Matters, and we'll see you again same time next week.